Hey everyone, welcome back to the Investing Meerkat channel where I share with you tips and tricks on how to invest smarter and better. If you're new here, don't forget to hit that subscribe button and turn on the notification bell so you won't miss any of my future videos. In today's video, I'm going to answer a question that some of you have been asking me: is Moomoo Stock Broker safe in this banking crisis? If you don't know what Moomoo is, it's an online trading platform that offers commission-free trading in the US, Hong Kong, and Singapore markets. It also provides a lot of professional tools, such as Level 2 market data, stock screener, AI alerts, and more. It sounds like a great deal, right? But is it too good to be true? And what about the banking crisis that's been going on lately? How does that affect Moomoo and its users? Well, first of all, let me explain what the banking crisis is. Basically, it's a situation where a large number of banks or financial institutions face liquidity problems or insolvency risks due to various factors, such as bad loans, frauds, cyberattacks, or regulatory actions. When this happens, it can cause a loss of confidence in the banking system and trigger a bank run, where depositors withdraw their money en masse. This can lead to a domino effect where more banks fail and the whole economy suffers. So how does this relate to Moomoo? Well, Moomoo is not a bank itself, but it works with different brokerage firms that are regulated by different authorities in different markets. For example, in the U.S. market, Moomoo works with Moomoo Financial Incorporated, which is registered with and regulated by the SEC and FINRA. In the Singapore market, Moomoo works with Fudu Singapore Pte. Limited, which is licensed by MAS. And in the Hong Kong market, Moomoo works with Fudu Securities International, Hong Kong, Limited, which is regulated by SFC. These brokerage firms are responsible for holding your funds and securities in segregated accounts that are separate from their own assets. This means that if they go bankrupt or face any legal issues, your money and stocks are protected and can be transferred to another broker or returned to you. In addition, these brokerage firms are also members of different insurance schemes that provide further protection for your funds and securities in case of their failure. For example, in the U.S. market, Moomoo Financial Incorporated is a member of Sipc, which protects securities customers of its members up to $500,000, including $250,000 for claims for cash. In the Singapore market, Fudu Singapore Pte. Limited is a member of SDIC, which protects deposits up to 75,000 Singapore dollars per depositor per scheme member. So as you can see, Moomoo has taken various measures to ensure the safety and security of your funds and securities on its platform. However, this does not mean that there are no risks involved when using Moomoo or any other online trading platform. You still need to be aware of some potential pitfalls and challenges that may arise when investing in different markets. For example, you need to consider the currency risk when investing in foreign markets. This means that the exchange rate fluctuations between your home currency and the foreign currency may affect your returns or losses. You also need to consider the tax implications when investing in foreign markets. This means that you may be subject to withholding taxes or capital gains taxes by the foreign authorities or your home country depending on your residency status and tax treaties. Another thing you need to consider is the platform risk when using Moomoo or any other online trading platform. This means that there may be technical glitches, system errors, or cyberattacks that may disrupt your access to your account or affect your order's execution. You also need to consider the customer service risk when using Moomoo or any other online trading platform. This means that you may encounter difficulties or delays in reaching out to their support team or resolving your issues. So what can you do to minimize these risks and maximize your benefits when using Moomoo or any other online trading platform? Well, here are some tips that I can share with you. Do your own research before investing in any market or product. Don't rely solely on the information or recommendations provided by Moomoo or any other online trading platform. Always verify the sources and accuracy of the data and analysis. Diversify your portfolio across different markets and products. Don't put all your eggs in one basket. Try to invest in different sectors, industries, regions, and asset classes. This way, you can reduce the impact of a single market downturn or a specific event on your portfolio performance. Rebalance your portfolio periodically. This means that you should adjust your portfolio allocation according to your risk tolerance and investment goals. For example, if your portfolio becomes too heavy on stocks due to market appreciation, you may want to sell some of them and buy more bonds or cash to restore your desired balance. Use asset allocation funds or target date funds. These are funds that have a predetermined mix of stocks and bonds that suit your risk profile and time horizon. For example, a 60-40 fund will maintain a 60% stocks to 40% bonds or cash allocation. A target date fund will gradually shift from more aggressive to more conservative investments as you approach your retirement date. These funds can simplify the diversification process for you and save you time and effort. Invest in a mix of mutual funds or ETFs. These are funds that pool money from many investors and invest in a basket of securities that track a certain index, sector, theme, or strategy. For example, you can invest in an S&P 500 index fund that tracks the performance of the 500 largest U.S. companies. Or you can invest in a healthcare sector fund that invests in companies that provide medical products and services. Mutual funds and ETFs can give you instant diversification and exposure to various markets and segments. Customize with individual stocks and bonds. If you have more time, knowledge, and interest, you can also diversify your portfolio by picking individual stocks and bonds that match your criteria and preferences. For example, you can invest in some growth stocks that have high potential for future earnings. Or you can invest in some dividend stocks that pay regular income. Or you can invest in some corporate bonds that offer fixed interest payments. However, be careful not to overdo it and end up with too many holdings that are hard to manage and monitor. Consider alternative investments. These are investments that are not traditional stocks, bonds, or cash, such as real estate, commodities, cryptocurrencies, private equity, or hedge funds. These investments can offer higher returns or lower correlations with the mainstream markets, but they also come with higher risks and costs. Therefore, you should only invest a small portion of your portfolio in these alternatives, and only if you understand their pros and cons. So there you have it, 5 tips on how to diversify your portfolio. I hope you found this video helpful and informative. If you enjoyed this video and want to stay updated on the latest investing trends, tips, and expert advice, make sure to hit that like button and subscribe to the Investing Iguana. We're constantly working on new content to help you navigate the world of investments with confidence. And don't forget to hit the notification bell so you never miss any of our videos. If you have any questions or suggestions for future topics, feel free to drop a comment below. We love hearing from our audience. Thank you so much for joining us today, and we'll see you in the next episode. Until then, keep investing wisely and growing your wealth. This is the Investing Iguana, signing off.